Well, the longest bull market in history is failing to fix the financial problems at many of America's largest pensions. According to the report in the Wall Street Journal, the money that is owed to retirees are accelerating faster than the assets are growing to pay for those future obligations. So we asked the CIO of one of the world's largest pension funds why so many of them are still hurting, even as the stock market has jumped over 300% from its 2009 lows. Here's what CalSTRS CIO Chris Ailman told us.
Well, Brian, you're measuring it from the bottom of a trough to the top of a hill. You got to go back and look at the other side. It's almost like the Grand Canyon. We dropped down to a bottom in '09, climbed back to a peak where we are now. We're literally about where we were in the late 1980s. So the other thing that's changed in this time period is, you know what, longevity. People are living longer, and therefore the cost of retirement is going up, not just for public pensions, but for everybody. So when I step back and take a longer-term picture, pensions are about where we were in the 80s. We survived. I think that's the headline should be, is we survived the 2000s, and now we're slowly making our way back. But you're not going to fix a pension just in a 10-year period from a bottom of '09 to where we are now in 19.
Yeah, listen, and I know your views on the equity market. You think that we're sort of in the later stages of this run, but your job is to make the return to pay for the pension fund for all the pensioners that you guys have at CalSTRS. So where are the gains going to be made? If it's not in straight equities, is it in private equity? Is it in real estate? Is it in a combination?
Brian, I'd answer you and say yes, it's actually in all of those.
I shouldn't have given you D, all the above.
There you go. It's a heck of a challenge. The reality is I've got to make a 7% return, not just this year and not just in 2020, but for the next 30 years. I've got to average that. So I'm going to spread my portfolio around. I am going to be in real estate. I'm going to be in private equity. I'm going to be in infrastructure for low, stable returns. I'm even going to be in fixed income to help balance my portfolio. So I do need global growth. I need positive GDP around the world. Probably is between 2 to 3% in high growth areas like the emerging markets. But I definitely need Europe, U.S., and Japan to have at least a positive GDP to be able to generate that 7%.
When you say infrastructure, is that opportunity zones?
You know, we're starting to look at that. It's a really interesting area, and it's mostly tax credits. And since we're tax exempt, I'm trying to figure out how we can fit into that. So that's an interesting new area. I'm going to be going to the Milken Conference and talking with Steve Mnuchin, or at least listening to him, to try and understand those better. I think infrastructure for us is stable, long-term assets that produce a nice, steady cash flow. That's the kind of income I need to help balance the risk in my portfolio. And
by the way, I will see you at that Milken Conference as well. CNBC will be there, too. All right, I want to switch gears to the IPO landscape. Uber, expected to make its debut, could be the biggest technology IPO ever, Chris. We've already seen Lyft with a rocky start. You think there's enough investor appetite for some of these high-tech IPOs like Spotify and Lyft where they simply haven't made the return, at least early in their life?
Yeah, I think there's a big question. As you know, Brian, I am not comfortable with their governance. I don't like this dual-class share at all. I think it's a failed governance model, but no, Silicon Valley is still wedded to it. But I also, you know, the question is with Uber and Lyft, it's a technology company. I kind of thought they were ride-sharing taxi companies. So that's been part of the challenge is, where's the revenue? They certainly have had challenges now from lawsuits and governance and the way they operate. So these companies are not out of the woods. And usually when you have an IPO, you want to see a nice, stable company with a long history of steady cash flow. And I think these companies still have some interesting questions and challenges. So I'm not surprised they're getting hit with questions from the investors. The valuations they're coming out at is such a growth trajectory. It is hard to see those companies continuing on that.
Would you avoid any equity that had a dual class voting or ownership structure?
You know, Brian, frankly, I wish I could. But the reality is, and it's hard for people to understand, I need to own the U.S. market as a whole bucket. I believe in passive index investing. So I'm going to own that whole market. That includes structures that I may not like dual class shares. But if it's in the U.S. market, I want to own that as a solid unit, because then I can trade that unit very effectively. At my size, at over $100 billion just in equity alone, we can move that money effectively. So We're going to be in those shares, but that doesn't mean we're going to give up. It means we're going to be an active owner and try and change the company into the future. They need to put a term limit on these dual class shares. If they want to use it to go public, that's fine for now, but they need to get rid of it after a few years.
I never would have asked you this in the years past that we interviewed, but they become more mainstream, so I will. And I know you like passive investing. Do you ever invest in some of these 2 and 3 times levered ETFs, 3 times bull, 3 times bear? Do you save a little portfolio for that, or do you view them as simply too risky because they have grown in size?
No, they've grown in size. In my perspective, they're a trading tool for people who are traders and want to almost bet on the directions in the market. Brian, we're investors, so I'm not going to use that kind of leverage in the equity market. And I generally don't use ETFs. I'm going to buy the market ourselves as a whole. And I'm not going to use anything more than just a little bit of leverage in the futures market, which is really just a power tool for us to move in and out of the physical market.
Why no ETFs, though, given the fact that their fees are so low? And we've seen some of these state pension funds. I think Nevada is one. They just gone to these ETFs and kind of forgotten about it.
Yeah, some of the other funds, it's a very effective management tool. In my case, I've got an awesome staff downstairs that runs over $100 billion of index money in-house ourselves. So I can replicate the abilities of an ETF inside with very low cost and without that little bit of management fee, which is very low, but also without doubling my custody costs. So for me, it's more cost effective to do it myself than to go out to an outside shop. But if you're a smaller fund, then it's a very effective tool. If you're an endowment, if you're a family office of smaller size, then ETFs are a nice tool to use.
Chris Ailman of CalSTRS, always a pleasure to get your review. Thank you very much for joining us here on Worldwide Exchange.
Thank you, Brian.
Thank you.